AI land grab is on. Google Cloud ended Q1 2026 with roughly $462 billion in revenue backlog. And that is just Google. Dell just reported 757% growth in AI optimized server revenue. So this is no longer just a story about AI demos, chatbots, or pilot programs. This is a story about companies racing to lock in the infrastructure behind artificial intelligence. This is Captain Pierce with SkiesCapital. Welcome back. This is episode 3 of the Token Economy series, and this is where the trilogy comes together. In episode 1, we looked at NVIDIA's massive commitment to future AI infrastructure. In episode 2, we looked at the token itself, the new unit of productivity inside corporate America. Now, in episode 3, we get the demand signal. Google Cloud's backlog is basically an enterprise waiting room. Companies have committed to future cloud and AI capacity, but Google has not recognized that revenue yet because the services still need to be delivered. And that tells us something important. Corporate America is no longer just testing AI. Companies are trying to secure capacity before their competitors do. So the question is no longer simply, is AI demand real? The better question is, can the hyperscalers build enough infrastructure fast enough to meet it? Think clearly. Invest better. Let's go. Now let's define what this backlog actually means. The accounting term is remaining performance obligations, or RPO. That sounds complicated, but the concept is pretty simple. It represents customer contract commitments that Google has not yet recognized as revenue because the services still have to be delivered. Think of it like a sold-out concert. The tickets are sold, the seats are committed, but the show still has to happen. That is basically what Google Cloud's backlog represents. At the end of Q1 2026, Google Cloud had roughly $462 billion in revenue backlog, and that backlog nearly doubled quarter over quarter. At the same time, Google Cloud revenue grew 63% year over year. So the message is clear. Demand is not the issue. The issue is delivery. Google has to scale the compute, the data centers, the TPUs, the power, the cooling, and the networking required to turn those commitments into actual revenue. That is the bottleneck. And this is why the AI infrastructure build-out is becoming one of the largest capital deployment cycles we have ever seen. This is no longer just an AI software story. This is an infrastructure story. Now we move from the backlog to the behavior. Why are companies signing these large multi-year commitments? Because enterprise AI is not like downloading a simple software app. In the old SaaS model, software felt flexible. You could add seats, remove seats, change vendors, or adjust usage over time. But enterprise AI is different. AI requires compute capacity. It requires chips. It requires power. It requires data centers. It requires networking. And when that capacity is scarce, companies do not want to wait until they need it. They want to reserve it before their competitors do. That is why this buying behavior matters. This is not corporate America playing with AI pilots anymore. This is corporate America trying to secure access to the infrastructure layer. One reported example is ServiceNow, which was said to have committed roughly $1.2 billion to Google Cloud over 5 years. The companies have also officially expanded their partnership around Gemini Enterprise and ServiceNow's AI platform. And that is the bigger point. Google is not just selling raw compute. Google is trying to sell the full stack. First, custom silicon. Google has its own TPUs, which gives it more control over cost, supply, and performance. Second, native models. Gemini is not sitting outside the cloud. It is being integrated into Google Cloud's enterprise platform. And third, the agentic ecosystem. This is where AI starts moving from chatbots to actual business workflows. Agents that can help monitor systems, resolve issues, automate processes, and operate inside the enterprise. So the race is not just about who has the best model. It is about who can deliver the full AI operating layer to corporate customers at scale. Now, the next question is obvious. Who is actually in the queue? And to be precise, Google does not give us a customer-by-customer breakdown of its $462 billion cloud backlog. But public disclosures, reported commitments, and major enterprise AI partnerships give us a pretty clear picture of the two customer groups driving this demand. The first group is the AI infrastructure builders. These are the hyperscalers and frontier AI platforms building massive compute capacity. Amazon Web Services, Microsoft Azure, Google Cloud, Meta, and frontier AI labs like Anthropic. These companies are not just buying software. They are building AI factories. They need chips, data centers, power, cooling, networking, and cloud capacity at a scale we have never seen before. The second group is the enterprise customer base. This is where the story gets even bigger. Financial services, retail, healthcare, industrial manufacturing, software companies, capital markets firms, these are companies trying to bring AI into real business operations, not just chatbots, but customer service, software development, fraud detection, supply chains, data analysis, automation, and eventually agentic workflows that can actually perform tasks inside the business. That is why this queue matters. It is not one customer, it is not one industry, it is not one use case, it is a broad demand wave moving through the entire economy. And that is the common thread. Whether we are talking about hyperscalers building AI factories or enterprises locking in capacity, the destination is the same: more compute, more infrastructure, more tokens. And that demand does not stop at Google. It flows into servers, it flows into semiconductors, it flows into power systems, it flows into cooling, it flows into networking, and it flows into the data center supply chain. That is why the $462 billion backlog is so important. It is not just a Google number. It is a signal that the AI infrastructure race is moving from theory to execution. Now, this is where the demand signal gets confirmed, because Google's backlog is powerful, but it is still one data point. So the next question is, are we seeing that same demand show up anywhere else in the supply chain? And the answer is yes. Dell just reported a blowout Q1 fiscal 2027 quarter. Revenue came in at roughly $43.8 billion, up 88% year over year. AI server revenue grew 757%. Dell recognized $16.1 billion of AI server revenue in one quarter, and the company exited the quarter with roughly $51.3 billion in AI server backlog. That is not a small signal. That is enterprise and hyperscaler demand showing up in actual hardware orders. And Dell raised its full year AI server guidance to roughly $60 billion. So now we are not just talking about theoretical AI adoption. We are talking about servers being ordered, racks being built, data centers being filled, and supply chains being pulled higher. Dell is the obvious example because it is directly tied to AI servers, but the demand does not stop there. HPE is competing in rack-scale AI servers. Vertiv is tied to the cooling and power infrastructure that makes these data centers possible. Arista is tied to the networking layer because AI clusters need fast, low-latency data movement. Eaton is tied to electrical infrastructure and power distribution. And data center REITs like American Tower and Equinix are tied to the physical footprint, the space, interconnect, and power density needed to support this build-out. That is the key point. The AI boom is not just a software story. It is not just a chip story. It is an infrastructure story. Google's backlog tells us customers are signing up for future capacity. Dell's quarter tells us the infrastructure build-out is already moving through the supply chain. And that is why this matters for investors. When demand moves from contracts to servers to power to cooling to networking to physical data centers, that is when a theme starts becoming a real economic cycle. Now we move from demand to capacity. Google Cloud has the backlog, but backlog by itself does not create revenue. The services still have to be delivered. That is why Alphabet's capital expenditure plan matters so much. For 2026, Alphabet raised its CapEx guidance to roughly $180 to $190 billion. That is an extraordinary number. And this is not about building traditional server rooms. This is about building AI factories. Data centers designed around massive compute clusters, TPUs, networking, power, cooling, everything required to turn AI demand into actual delivered capacity. And this is where the full trilogy connects. In episode 1, we looked at NVIDIA and the massive supply commitments being made to support future AI demand. In episode 2, we looked at tokens, the new unit of productivity inside the AI economy. And now, in episode 3, Google Cloud's backlog gives us the demand signal. Companies are signing the contracts. Hyperscalers are building the infrastructure. Semiconductor and data center suppliers are being pulled into the cycle. That is the loop. The token economy is not just software. It is physical infrastructure. And the companies that control that infrastructure may control one of the most important economic choke points of the next decade. So how do we actually put this to work as investors? First, understand the infrastructure layer. The token economy does not run on hype. It runs on physical hardware. Semiconductors, data centers, power, cooling, networking, cloud infrastructure. That is why companies like NVIDIA, ASML, Google, Microsoft, and Amazon matter in this cycle. They are not just participating in AI. They are helping build the rails that AI runs on. Second, think in terms of picks and shovels. You do not have to pick the single winning AI model to benefit from the build-out. The companies supplying the inputs, power systems, liquid cooling, electrical equipment, fiber, networking, and data center capacity may benefit regardless of which model or cloud platform ultimately wins. Third, watch the conversion. A backlog is only valuable if it turns into revenue, margin, and cash flow. So over the next several quarters, I would be watching Google Cloud revenue growth, backlog conversion, operating margins, and the relationship between CapEx and revenue. If CapEx starts to stabilize while revenue and margins continue to accelerate, that may be the signal that the infrastructure spend is beginning to translate into real operating leverage. And fourth, keep valuation discipline. A real structural tailwind does not mean every stock is a buy at any price. The token economy may be real, but parts of the market can still get overhyped. The goal is not to chase the story. The goal is to find great businesses tied to a real structural shift at prices that still make sense. So let's bring this in for final approach. Across this three-part series, we have looked at the token economy from three different angles. Episode 1 was the hardware side. NVIDIA's massive supply commitments showed us that the AI infrastructure build-out is not theoretical. Companies are committing real capital to secure the hardware needed for the next wave of AI compute. Episode 2 was the productivity side. Tokens are becoming the new unit of work inside the AI economy. Not just a technical measurement, but a business measurement. Cost per million tokens, output per token, productivity per token. That is how companies are beginning to measure the economics of AI. And now episode 3 gives us the demand signal. Google Cloud's roughly $462 billion backlog tells us that major customers are signing long-term commitments for future cloud and AI capacity. That is the loop: hardware supply, token economics, enterprise demand. And when you connect those three pieces, the token economy stops looking like a buzzword and starts looking like an infrastructure cycle. But this is where investors need to stay disciplined, because two things can be true at the same time. The AI infrastructure build-out can be real, and parts of the market can still get overvalued. The opportunity is not to chase every stock with an AI label. The opportunity is to understand where real demand is showing up, which companies control the choke points, and whether the current price already assumes perfection. So, the big question is this massive token rush sustainable, or are we building the largest hardware bubble in human history? Drop your thoughts in the comments below. And remember, turbulence is not a change in flight plan. If you found this helpful, please like and subscribe. It genuinely helps the channel reach more long-term investors who are trying to think clearly about the companies they own. This has been Captain Pierce with SkiesCapital. Think clearly, invest better, for educational purposes only, not investment advice. Keep the blue side up and safe skies.